Here is a sentence that should not be true, but is for millions of Canadians. You can earn $100,000 a year and still be broke. Not struggling in the way someone earning $35,000 struggles, but broke in the specific financial sense. No meaningful savings, significant consumer debt, one unexpected bill away from a crisis, and a net worth that does not reflect the income that has been passing through your accounts for years. 41% of Canadians are within $200 of financial insolvency each month. This is not 41% of low-income Canadians. It is 41% of Canadians, across income levels, across provinces, across demographics. A significant number of people in that 41% earn what most people would consider good money. Being broke is not about income. It is about the relationship between income and the 5 specific financial conditions this video covers. You can have a high income and be broke. You can have a modest income and not be broke. The difference is not the paycheck. It is these 5 signs. And here is the uncomfortable, useful truth. The 5 signs are specific, identifiable, and correctable. By the end of this video, you will know exactly which ones apply to you, and exactly what to do about each one. The sign: your bank account is significantly lower the day before payday than it is the day after. The cycle resets every 2 weeks. There is no meaningful float, no buffer between what comes in and what goes out. An unexpected $500 expense would require borrowing, using a credit card, or skipping something else. Why income doesn't prevent this? Living paycheck to paycheck is not caused by low income. It is caused by spending that expands to fill available income, a phenomenon called lifestyle inflation, combined with the absence of an automatic savings mechanism that removes money before it can be spent. A Canadian earning $50,000 living paycheck to paycheck and a Canadian earning $120,000 living paycheck to paycheck are experiencing the same financial condition at 2 different income levels. The scale is different. The vulnerability is identical. The data: 41% of Canadians are within $200 of financial insolvency monthly. 46% would run into debt within 1 month of a financial shock. These figures span income brackets. Why it matters. Living paycheck to paycheck is not just uncomfortable, it is financially dangerous. It means that every unexpected expense becomes a crisis. A car repair, a dental bill, a month of reduced hours, any of these triggers debt accumulation. And debt accumulated in a crisis is almost always expensive debt. Credit card at 19.99%, payday loan at 390%, annualized BNPL plans that stack. The specific correction: pay yourself first, not last. The paycheck-to-paycheck cycle exists because saving is treated as what remains after spending. The structural fix is reversing the order. On payday, before anything else, an automatic transfer moves a fixed amount to a separate savings account. Start with $100 per paycheck if that is what is available. The amount matters less than the structure. The structure creates the buffer. The buffer breaks the cycle. The sign: you have been earning a reasonable income for 5, 10, or 15 years, and your net worth, the total of what you own minus what you owe, is not meaningfully higher than it was 5 years ago. The income came in. Life happened. The net worth stayed flat or barely moved. Why this is a sign of being broke. Net worth, not income, is the measure of financial health. A Canadian earning $85,000 per year with a $400,000 mortgage, $15,000 in credit card debt, 2 car loans totaling $55,000, and $22,000 in total savings, has a net worth of approximately negative $48,000. They earn $85,000 a year. They are broke, in the sense that their balance sheet is deeply underwater, and their income, while real, has not translated into owned assets. The lifestyle inflation mechanism. Lifestyle inflation, the tendency for spending to rise with income, is the primary driver of flat net worth despite rising income. The raise goes to a better car. The bonus goes to a renovation. The promotion goes to a nicer apartment. Each upgrade feels earned and reasonable in isolation. The aggregate result is that income increases and net worth does not. The specific Canadian context. Average household debt to income in Canada is $1.76 per $1 of disposable income. The average Canadian has $1.76 in debt for every dollar available to spend, meaning a significant portion of current income is servicing past spending rather than building future wealth. The correction. Calculate your actual net worth right now. Total assets minus total liabilities. If the number is negative or lower than it should be for your age and income, that number is the starting point of a plan, not a verdict. Set a net worth growth target for the next 12 months, a specific dollar amount higher than today. Track it quarterly. Net worth growth is the single most useful metric of financial progress. More useful than income, more useful than savings rate, more useful than investment return in isolation. Here is the vault, the one sign so completely normalized in Canadian financial culture that most people don't recognize it as a problem at all. The sign, your savings are sitting in a big bank savings account, earning 0.5% to 1.5% interest, while you have unused TFSA room, unused RRSP room, or both, or your TFSA is at the bank earning 2% to 3% in a savings account, rather than invested in a low-cost ETF earning a long-run 7 to 8%. Or you have an RRSP mutual fund at your bank charging 2.0% to 2.5% in annual fees. Why this is being broke? Being broke does not only mean not having savings, it also means having savings that are structurally working against you, earning below inflation returns in the wrong account, or being eroded by fees. A Canadian with $50,000 sitting in a big bank savings account at 1.5% while carrying unused TFSA room is voluntarily surrendering the tax-free compounding on $50,000, a decision that costs approximately $95,000 to $120,000 in foregone tax-free wealth over 25 years. That is not a small administrative oversight. That is one of the most expensive decisions in Canadian personal finance. The 3 structural savings mistakes. Mistake 1. Savings outside the TFSA when TFSA room exists. The average Canadian TFSA balance is $31,000 against $109,000 in cumulative room. Most Canadians have $70,000 plus in unused tax-free investment space. Any savings sitting in a non-registered account when TFSA room is available is generating taxable returns unnecessarily. Mistake 2. TFSA used as a savings account instead of an investment account. A TFSA is a tax shelter, not a type of account. The TFSA can hold ETFs, stocks, bonds, GICs, and mutual funds, not just savings deposits. A TFSA holding a bank savings product at 2.5% is using a Ferrari as a grocery cart. The tax shelter is there. The investment is not. Mistake 3. Active mutual funds with 2% plus MERs in the RRSP. As covered in the index investing video, The fee gap between a 2% MER mutual fund and a 0.20% ETF compounds to approximately $396,000 over 30 years on a $100,000 portfolio. Paying 2% in annual fees while earning the same underlying market return as a 0.20% ETF is not investing. It is paying someone to underperform an index. The correction: open a self-directed TFSA at Questrade or Wealth Simple. Transfer existing savings in. Buy XEQT. That is the entire correction for most Canadians. 30 minutes. One decision. One of the most consequential financial improvements available. The sign: you are carrying a car loan above $25,000. Your monthly vehicle payment is above $600. You financed the car for 72 months or more, or you leased a vehicle you could not have afforded to purchase. Bonus sign: you upgraded before the previous loan was paid off. The data: the average Canadian car loan is $30,396. TransUnion 2025. Average new car prices in Canada in 2026 are approximately $62,000. 84-month, 7-year financing terms are increasingly common. For many Canadians in their 30s and 40s, the car payment is the second largest monthly fixed expense after the mortgage. Why this is being broke: a $30,396 car loan at 6.9% interest over 72 months costs approximately $570 per month in payments and approximately $11,000 in total interest. The vehicle depreciates approximately 20% in the first year and 50% within 5 years. You are paying 6.9% interest on an asset that is simultaneously losing 10 to 20% of its value annually. The net wealth destruction from a new car purchase price plus interest minus residual value, is one of the largest avoidable wealth destruction events in a Canadian's financial life, and most Canadians do it repeatedly, trading in before the loan is paid off and rolling negative equity into the next loan. The opportunity cost, the number nobody calculates: $570 per month car payment invested at 7% for 25 years equals approximately $456,000. The new car that felt like a reasonable lifestyle choice is, in opportunity cost terms, approximately $456,000 of foregone retirement wealth. From one vehicle decision. The correction: the vehicle that optimizes financial outcomes is the reliable used car purchased outright or with a short loan, driven until the wheels fall off, then replaced. For someone in a strong financial position, a reasonable car budget is approximately 10 to 15% of gross annual income. A Canadian earning $70,000, spending $62,000 on a vehicle, is allocating nearly an entire year of gross income to a depreciating asset. The correction is not necessarily no car. It is a car that is proportionate to income and does not carry a payment into year 7. The sign: you do not have a specific retirement savings target. You do not know your current net worth to within $10,000. You could not say, without looking it up, what your total monthly expenses are. You have not opened your most recent credit card statement. You have a vague sense that things are fine-ish, or a vague sense that things are not fine, but no specific information to confirm either. Why this is the most important sign: every other sign on this list is sustained by the absence of information. Living paycheck to paycheck persists because nobody has calculated the specific buffer required to stop it. Flat net worth persists because nobody has measured it. Savings in the wrong place persists because nobody has compared the current structure to the available alternatives. The car loan persists because nobody calculated the opportunity cost before signing. Financial problems that are named and measured are solvable. Financial problems that are vaguely sensed, but not specifically known, are sustained indefinitely. Because you cannot address a problem you have not defined. The specific numbers most Canadians do not know about themselves. Their exact net worth. Their total monthly fixed expenses. Their total outstanding debt across all accounts. Their TFSA room remaining. Their RRSP contribution room remaining. Their estimated CPP benefit at 65, available on My Service Canada. Their retirement savings target based on their actual income needs. The correction: spend 2 hours this week answering these 7 questions. Write the numbers down. None of the answers require a financial advisor. They require only that you look at what already exists in your accounts and government records. The My Service Canada account shows your CPP estimate. The CRA, My Account, shows your TFSA room. Your financial institution's app shows your balances. The budget app, or a spreadsheet, shows your expenses. You cannot build toward a number you have never defined. The plan does not have to be complex. It has to exist. Let's come back to where we started. You can earn $100,000 and still be broke. Not because of bad luck or low income, because of 5 specific, identifiable, correctable financial conditions. Paycheque to paycheck, corrected by paying yourself first. Flat net worth despite rising income, corrected by measuring it and making lifestyle inflation deliberate. Savings in the wrong place, corrected by a self-directed TFSA with XEQT, opened in 30 minutes. A car costing you a retirement, corrected by understanding the opportunity cost before the next vehicle decision. No plan and no number, corrected by spending 2 hours answering 7 questions that are already answered in your accounts and government records. None of these corrections require a higher income. None require a financial advisor. None require complex strategies or advanced knowledge. They require only that the specific named problem gets a specific named response. Being broke in Canada in 2026 is a condition. Conditions change when the behaviors that sustain them change. The 5 signs are the map. The corrections are the path.